In 1907, the U.S. financial system nearly collapsed. Official records show J.P. Morgan stepped in to save the banks, but private letters reveal he and his associates first triggered the run by spreading rumors about weak trusts. Investigators found they bought assets at rock-bottom prices during the chaos. Months later, they lobbied for the Federal Reserve, a system they would control. This wasn't panic, was a demonstration: crash the system, then sell the solution. After 1907, a secret meeting took place on Jekyll Island. Senators and top bankers drafted the plan for the Federal Reserve. Declassified notes show their goal wasn't just stability, was centralized control over money supply. Before this, banks competed. After, they operated as a cartel. Investigations conclude the Fed was designed to create cycles. Expand credit, boom. Contract credit, bust. Crashes weren't failures. They were features built into the new machine. Throughout the 1920s, the Fed kept rates low, flooding markets with easy money. Then, in 1928, they abruptly raised rates and cut lending. Documents show insiders, bankers, and politicians sold all their stocks months before the crash, while encouraging the public to buy. Over 9,000 banks failed. The wealth transfer was historic. The richest 1% increased their holdings by 300%. Investigators call it the greatest planned heist in history. Far from fixing things, policies during the Depression deepened the crisis. Internal memos show major banks supported stricter regulations that crushed small competitors. Records prove asset values were deliberately depressed until big institutions could swallow railroads, utilities, and entire industries for pennies. Economists found the Depression didn't destroy wealth, moved it. The crash was the mechanism to consolidate power into fewer hands. For decades, the dollar was backed by gold. In 1971, Nixon ended convertibility overnight. Declassified Treasury transcripts revealed this was planned years prior. The move triggered inflation, higher oil prices, and a global recession. Insiders knew removing gold discipline gave central banks total control. Crashes could now be manufactured simply by printing too much, then stopping. The system shifted from value-backed to debt-backed, making collapse inevitable by design. In the late 70s, inflation rose. Fed Chair Paul Volcker raised interest rates to 20%, deliberately inducing a deep recession. Minutes show they knew this would destroy savings and crush developing nations. It worked. Countries borrowed to survive, falling into permanent debt to the IMF. Investigations prove this was a coordinated strategy to force global dependence on Western capital. High rates weren't a cure. They were a weapon to capture entire economies. The Dow dropped 22% in one day. Official reports blamed computer trading, but investigations found the same firms that sold the software also bet heavily on the crash. Trading logs show coordinated selling from just a handful of banks. Internal reviews revealed the safety mechanisms were actually triggers. Insiders made billions, while ordinary investors were wiped out. It proved markets could be crashed remotely, precisely when and where it benefited the biggest players. In the 1980s, deregulation allowed S&Ls to gamble with deposits. When they failed, the government bailed them out for $124 billion. Court documents prove many owners were encouraged by big banks to make risky loans, then looted their own institutions before collapse. Investigators found the bailout money flowed straight to large financial firms. The crisis was manufactured through deregulation, creating a crash that transferred public wealth to private pockets. In 1997, currencies across Asia collapsed. Investigations show hedge funds coordinated massive short sales, attacking Thailand, Indonesia, and South Korea one by one. IMF loans arrived with strict conditions: sell state assets, open markets, remove protections. Western banks bought banks, utilities, and industries at fire sale prices. Leaders later admitted the crisis was engineered to break Asian independence and force them into the global financial fold. Through the 90s, banks hyped every internet stock, knowing most had no value. Internal emails show analysts called companies junk while publicly rating them strong buy. Once public money flooded in, insiders sold. The crash wiped out $5 trillion. Afterwards, regulations were loosened further. Investigations conclude it was a classic cycle. Inflate a bubble, let the public buy the top, collapse the market. Then strengthen control over the remaining financial landscape. The Glass-Steagall Act separated regular banks from investment banks for 66 years. In 1999, it was repealed, lobbied heavily by Citigroup and others. Investigations show insiders knew this would create too-big-to-fail institutions. They removed the only rule preventing banks from gambling with savings. The law wasn't repealed to help the economy. It was repealed to enable the massive crash that followed. The safety rail was removed on purpose. For years, banks lent to anyone, even those who couldn't pay. They bundled bad loans into AA securities, rated fraudulently. Internal documents prove banks knew the loans were toxic, yet bet against them while selling them to clients. When the music stopped, they claimed surprise. Investigations found the collapse was timed. They crashed the system only after securing insurance and bets that paid out billions when homeowners lost everything. After 2008, governments spent $14 trillion rescuing banks. Yet, documents show the banks were already solvent through secret central bank loans months earlier. The public bailout was a transfer. Taxpayers paid for losses, while executives kept bonuses. Investigations reveal the crisis was used to justify greater central bank power. More regulation and the consolidation of 5,000 banks into 4 mega institutions. Crisis became the excuse for total dominance. Agencies like Moody's and S&P are paid by the banks they rate. Investigations after 2008 prove they knowingly gave top grades to toxic assets to keep business flowing. Whistleblowers admitted they would downgrade entire sectors only when insiders were ready to exit. By controlling ratings, they control confidence. Downgrades trigger crashes. Upgrades inflate bubbles. They are the ignition switch for planned cycles. Warren Buffett called derivatives financial weapons of mass destruction. Investigations show these complex bets now total $600 trillion minus 10x the global economy. Banks use them to secretly bet on crashes, hide debt, and manipulate markets. Regulators admit they can't track them. The system is designed so that when derivatives unwind, collapse is inevitable. It's a trap set deep in the code of modern finance, ready to snap shut when required. Central banks now publicly announce their plans. Investigations show this is not transparency, it is coordination. They signal rate hikes or cuts well in advance, giving insiders time to position themselves. The public follows the signal, then gets crushed when the move happens. Studies prove the biggest profits are made by those closest to the bank. Guidance turns monetary policy into a game where only the House knows the rules. Over 70% of senior U.S. Treasury officials and central bank leaders come directly from Goldman Sachs, J.P. Morgan, or similar firms. Investigations show they write rules that benefit their former employers, then return for massive paydays. When a crash looms, regulators leak warnings to friends. Enforcement is light, fines are small, and laws are written to protect the system. The watchdogs are the owners. Stability is sacrificed for profit. Inflation is a hidden economic crash. By printing trillions, central banks devalue currency. Investigations prove inflation is never accidental. It transfers wealth from savers to borrowers. The biggest borrowers is the government, while the biggest beneficiary is the banking system. Every dollar lost to rising prices is a dollar moved from ordinary people to the financial elite. It's a crash in slow motion, planned and legal. After every crash, governments impose austerity, cut services, raise taxes, sell assets. Investigations reveal this is standard playbook. Loans from the IMF or World Bank require these measures. Public wealth, water, energy, transport is sold cheap to private corporations. Austerity doesn't fix the economy. It strips it. The crash creates the crisis. The takeover is the goal. It happens in every country that falls into the cycle. Nations and banks deliberately devalue currencies or attack rivals. Investigations show the 1990s ruble collapse, the 2015 yuan devaluation, and the 2022 pound flash crash were all driven by coordinated trading. By destroying a currency, you destroy a nation's purchasing power and independence. Economic crashes are weapons used to bring nations to heel, forcing them to adopt policies favorable to global financial powers. Every bubble tech, housing, crypto commodities is created by easy credit. Investigations prove central banks know exactly what they are doing. Low rates force money into risky assets. The public sees wealth and joins in. When the bubble is fully inflated, credit tightens. The crash follows. Economists confirm bubbles are not market errors. They are deliberate wealth transfer mechanisms. The rich buy early, the poor buy at the peak. History shows bank holidays or trading halts always follow preparation. In 1933, 2008, and 2020, closures were planned weeks in advance. Insiders moved funds to safety while the public had no access. Investigations prove these pauses are used to reorganize the system, protect large institutions, and freeze losses. They are not emergency measures. They are controlled demolition to ensure the structure falls only on those below. In 2020, markets crashed 35% in weeks. While blamed on health measures, investigations reveal banks were already positioned for collapse 6 months prior. Central banks pumped $9 trillion into markets immediately directly to large firms. Small businesses were crushed, but stock markets hit new highs. Data shows the wealth of billionaires rose by 50%. It was the first time the economy was shut down by decree, proving crashes can be ordered on command. Every crash moves us closer to central bank digital currencies, CBDCs. Investigations show planners use instability to argue. The old system is broken. We need something new. CBDCs will give total control. Track every transaction, freeze accounts, program spending. Crises are the marketing tool. Each collapse destroys trust in cash and banks, pushing people toward the controlled digital system. The crashes are the bridge to total financial surveillance. After every crisis, banks get bigger. Investigations confirm too big to fail is not a problem, it's a business model. Knowing they will be bailed out, they take bigger risks, create bigger bubbles, and engineer bigger crashes. The bigger they are, the more power they hold. The system is rigged so that failure for them means profit. Failure for you means ruin. Crashes ensure they never actually lose. Universities are funded by banks and think tanks. Investigations show economic theories taught like the efficient market hypothesis are designed to hide manipulation. They teach crashes are natural, inevitable, random. Meanwhile, internal models used by banks predict crashes perfectly. Economics is not a science. It's a narrative to convince the public that what happens to them is fate, not design. Major news outlets are owned by corporations with massive financial stakes. Investigations show they hype bubbles' new era, permanent prosperity right before collapse, then report crashes as unforeseeable disasters. They never question the system itself. Media turns planned events into stories of bad luck or greed. The goal: keep the public confused angry at each other and blind to the architects pulling the strings. Crashes are always debt crises. Investigations prove the system is built on debt money, created out of nothing, lent at interest. The total global debt is now 3x global GDP. It can never be repaid. The plan is perpetual cycle. Lend more gives boom, gives call-in loans, gives crash, gives seize assets. Debt is the chain. The crash is the moment the chain is pulled tight. It is mathematically guaranteed to fail by design. Groups like the Bank for International Settlements, BIS, IMF, and World Economic Forum coordinate policies globally. Investigations show they meet regularly to align interest rates, credit flows, and crisis responses. They don't prevent crashes. They manage the timing so wealth shifts globally in their favor. When one region is targeted, others are protected. It is a synchronized machine, crashing parts of the world to maintain control of the whole. Former bankers, traders, and analysts have spoken out. Their testimonies are consistent. We knew when it would end. We were told to sell to clients. Crashes are part of the plan. They describe internal calendars for credit expansion and contraction. They confirm bonuses are tied to successful boom-bust cycles. The insiders admit it openly. Markets are not free. They are managed. Crashes are planned events. For over 200 years, crashes repeat every 7 to 10 years. 1837, 1847, 1857, 2000, 2008, 2020. Investigations show this rhythm matches exactly with central bank credit cycles. It is not coincidence. It is a heartbeat. Every decade, the system contracts, resets, and restarts. The pattern is so precise, it can only be planned. It is the oldest trick in finance. Let them rise, then cut them down. After every crash, inequality spikes. Data shows the richest 1% doubled their share of global wealth since 1980, accelerating after each crisis. Investigators conclude this is the primary objective. Crashes are the only mechanism powerful enough to transfer trillions in a short time. If crashes were accidental, wealth would distribute more evenly. Instead, it concentrates. That is proof of intent. Yes, investigations detail exactly how. Restrict credit, raise rates, withdraw liquidity, spread fear. Coordinate selling, downgrade assets. All tools are legal, controlled by central banks and big banks. It is not illegal, it is policy. They don't hide it, they just call it monetary tightening or correction. The ability to create collapse is built into the authority granted to them. They have the switch. They choose when to flip it. After analyzing 200 years of documents, meeting minutes, trading data, and insider testimony, the conclusion is certain. Economic crashes are not accidents, not failures, and not natural disasters. They are planned, timed, and executed events. They serve to transfer wealth, consolidate power, reset debt, and justify greater control. The instability is the point. The crisis is the goal. Knowing crashes are planned changes everything. It means the system works exactly as designed, not for you, but against you. The question now is, will we accept being subjects of this cycle forever? Or will we demand a system where money serves people, not power? The evidence is clear. The crashes will keep coming until we understand who is driving the bus and take the wheel back.